Welcome to the Daily Stock Beaver Market Briefing. Today is August 7, 2026, and we're going to dive straight into the market snapshot. The S&P 500 closed at 77.55, up 0.59% today and 3.55% for the week, its best weekly advance since April. Gold surged to $43.99 an ounce, up 2.3% on the day, after a stunning July jobs report showed the economy lost 23,000 positions when every economist surveyed expected growth. Crude oil fell to $77, down nearly 9% on the week, and Bitcoin held above 64,000 but notably lagged the equity rally. Here's what's driving all of it. The week's dominant force was the July non-farm payrolls report. Not a single economist among the roughly 75 surveyed by Bloomberg expected a contraction, yet the economy shed 23,000 jobs, with May and June revised down by another 103,000. That shock cascaded across every asset class. Traders slashed bets on a September rate hike, the dollar weakened, and risk assets surged, with the NASDAQ posting its strongest week since April at 5.17% over 5 sessions. At the same time, President Trump revived his push to remove Federal Reserve Governor Lisa Cook over mortgage fraud allegations, weeks after the Supreme Court blocked a prior attempt. That move injects fresh uncertainty into Fed independence at the exact moment markets are pricing a dovish pivot. We'll dig into the credit and Treasury picture later in the show, plus a much deeper look at the precious metals surge. Earnings season delivered several headlines this week. Airbnb surged over 15% Friday after beating earnings and revenue estimates, with CEO Brian Chesky crediting AI integration and raising the full-year outlook. AMD posted record quarterly revenue of $11.5 billion with diluted EPS of 1.38, but shares slipped on near-term PC and gaming weakness even as data center revenue surged. Caterpillar reported sales of $20.5 billion, up 24% year-over-year, with its power and energy backlog stretching into 2029 on AI-driven electricity demand. And Shopify delivered its strongest post-earnings reaction in years, with gross merchandise volume up 32% to $116 billion. The pattern across asset classes is unmistakable. A weakening labor market became a green light for stocks, gold, and bonds simultaneously. A retreating dollar is amplifying commodity strength, while political pressure on the Fed adds a wildcard. This is a classic bad news is good news rally, and the breadth is remarkable. Here are your key numbers. The S&P 500 rose 0.59% to 77.55. The NASDAQ climbed 1.28% to 26,686. The Dow added 0.28% to 54,036. And the Russell 2000 gained 1.1% to 3034. The VIX Fear Index sits at 14.9, signaling genuine calm, and the overall market regime remains bullish. On bonds, the long-duration ETF TLT rose 0.29%. The 10-year Treasury yield holds at 4.63%, essentially unchanged. The U.S. national debt stands at roughly $39.9 trillion, up about $60 billion from yesterday, and will go deep on the federal budget later. Gold rose 2.3% to $43.99 an ounce. Silver jumped 3.3% to 63.66, and will go much deeper on precious metals coming up next. Oil slipped to $77. Bitcoin added 1% to 64,935. 12 sectors finished green, just 2 in the red, and the rotation story traces directly back to that jobs report. Software led the entire market with a 3.29% gain, as investors piled into growth names on expectations that rate hikes are effectively off the table. Semiconductors added 2.2%, and broad technology rose 1.55%. The notable standout was materials, up 1.48%, driven by the precious metals surge as gold and silver rallied hard on dollar weakness. Consumer discretionary gained 1.42%, powered by Airbnb's 15% pop. On the losing side, energy was the day's laggard at minus 1.7%. Crude has fallen nearly 9% this week, a clear signal that traders see demand softening alongside the labor market. Financials dipped 0.35%, a telling divergence from the broad rally, because lower rate hike expectations compress the net interest margins that banks depend on. The message beneath all that green: money is flowing toward rate-sensitive growth in hard assets, and away from anything tied to a booming economy or higher interest rates. That split tells you exactly what the market expects from the Fed next. Weekend review. The week from July 31 through August 7 was a textbook bad news is good news rally. The July payrolls report showed the economy shed 23,000 jobs when every economist surveyed by Bloomberg expected growth, and that single data point reframed the entire week. The NASDAQ surged 5.17%, its best week since April. But the Russell 2000 tells you what the market is really thinking. It climbed 3.52% this week, yet it's up nearly 21% year-to-date, leading every major index. Small caps are the most rate-sensitive cohort in the market, and when they outperform, it means traders are pricing in the end of the hiking cycle. The year-to-date lens reveals a rotation story more interesting than any single weekly rally. Software was the single best sector this week at plus 8.57%, yet it sits at just plus 0.7% for the year. That gap is a catch-up trade in pure form. Money that avoided rate-sensitive growth names all year flooded in the moment rate hikes looked off the table. Semiconductors tell the opposite story, up 7.6% this week and 73% year-to-date. When a sector leads both timeframes, you're seeing genuine structural momentum, not just a relief bounce. Energy fell 3.33% this week despite being up 26% year-to-date. That pullback traces directly to the payrolls number. If hiring is contracting, traders assume fuel demand softens next. Materials gained over 6%, driven almost entirely by the precious metals surge on dollar weakness and Fed uncertainty. The cross-asset signal this week was remarkable for its breadth and its contradictions. Gold surged 7.11% and silver jumped 10.16%, yet silver is still down 12.56% year-to-date. That divergence tells you this week's precious metals rally is a sharp reversal of a year-long trend, not a continuation. What makes it unusual? Those safe haven gains came alongside the equity rally. Normally gold rises when stocks fall, investors fleeing risk. Here, everything rose together. That only happens when a single catalyst simultaneously fuels risk appetite and safe haven demand. The payrolls shock and President Trump's revived effort to remove Fed Governor Lisa Cook did exactly that. Crude oil tells the mirror image story, down 8.95% this week, but still up 33.67% year-to-date. The market is rapidly repricing demand expectations against lingering geopolitical supply risks. Bitcoin added 2.26% on the week, but remains down nearly 27% year-to-date. It notably failed to participate in the equity euphoria, capped by regulatory uncertainty as crypto legislation stalls in Congress. The verdict: a contracting labor market bought the Fed time and lit a fire under equities and precious metals simultaneously. But margin debt reached $1.5 trillion in June, up 49% year-over-year, and corporate bond breadth deteriorated sharply with declines outpacing advances. That late-cycle tension is what listeners should watch heading into next week's inflation data. Now let's dig into the commodities story driving so much of this week's action. Commodities. The dominant commodities story is a stark divergence between fear and growth. Heating oil is up 83.5% year-to-date, and gasoline futures have gained 59.6%. Those are supply disruption premiums built on months of Strait of Hormuz tension. When refined products outpace crude itself, the market is pricing a bottleneck in processing and shipping, not just raw material scarcity. Rough rice futures are up nearly 40% and wheat is up 38.6% year-to-date, weather-driven supply concerns and export restrictions feeding straight into global food costs. Meanwhile, gold near $4,400 and silver above $63 are telling you investors want hard assets, and they want them now. The energy story this week is two forces pulling in opposite directions. On one side, Iran published a draft plan restricting ship traffic through the Strait of Hormuz, and India's Reliance just paid a record $23 to $25 million to charter a single supertanker through the Gulf. Those are real, physical supply constraints. On the other side, WTI crude fell to $77.15, down 8.9% on the week, and wholesale gasoline futures dropped 12.9% over 7 days. The market is saying that demand destruction from a weakening labor market outweighs the supply risk, at least for now. Natural gas slipped to $2.67, down 2.8% on the week and 26% year-to-date, despite the structural demand narrative from LNG exports and AI-driven electricity needs. When a commodity with a bullish long-term story keeps falling, near-term supply is overwhelming the demand argument. And that tells you the structural thesis isn't enough to override cyclical weakness. The EIA's weekly data through July 31 actually supports a tighter physical market than the price action suggests. Commercial crude inventories drew 2.8 million barrels, and gasoline stocks fell another 1.6 million. Both draws are consistent with firm summer demand, not oversupply. So the physical market looks balanced to tight, yet futures are falling. That gap tells you traders are positioning for future demand weakness, not current weakness. The spot market and the futures market are telling different stories, and that divergence is where opportunity, or a trap, lies. Our internal positioning data reveals a fascinating split in energy. In crude oil, big traders, the hedge funds and CTAs, hold a notably subdued bullish stance, with long positions at just the 15.5th percentile of the past 6 years. They're hardly betting on a breakout. But here's what stands out. The producers, the companies that actually pump the oil, have their hedging at the 1.8th percentile, effectively the lightest on record. When the industry players who know the business best refuse to lock in prices, they're telling you they expect prices to go higher, or they simply can't afford to hedge at these levels. Given the geopolitical backdrop, the first interpretation fits. Gasoline tells the opposite story. Big traders are long at the 98.4th percentile, near the highest concentration in 6 years. That's a crowded trade. If Hormuz tensions ease, those gasoline longs are extremely vulnerable to a sharp reversal. The precious metals rally is the clearest signal in markets right now. Gold at $4,400 and silver at $63.65, silver up over 10% this week alone, are driven by the convergence of dollar weakness, Fed uncertainty, and political drama around Governor Cook. Copper is up 1.8% this week and 15.7% year to date, confirming the manufacturing bright spot in the jobs data. But silver is the quiet anomaly. Despite gold euphoria, silver's big trader longs sit at just the 10.1st percentile. Either silver is a laggard about to catch up, or the market is correctly discounting its industrial demand sensitivity to a slowing economy. Gold positioning is approaching crowded territory. Big traders are long at the 95th percentile of the past 6 years, against virtually no short interest at the 4.6th percentile. When nearly everyone is on the same side of a trade, it stops being a high-conviction bet and starts becoming a setup where any surprise triggers a rush for the exit. Mining companies aren't locking in prices either. Producer hedge shorts also sit at the 4.6th percentile, telling you they expect prices to keep climbing. The risk is straightforward. With this much consensus, a hot inflation print that revives rate hike fears could force a sharp unwind. Palladium carries our moderate risk flag at 50.2% short, but velocity has turned positive, covering has begun. Any supply disruption from Russia would force a squeeze in a market already starting to shift. For your grocery bill, the most notable moves are sugar futures up 12.5% this week and coffee down 5.6%. These are wholesale futures prices, not retail. Consumer costs tend to follow with a lag and a smaller impact. Wheat futures, up nearly 39% year to date, remain the standout agricultural story on global supply concerns that show no signs of resolving. The most actionable signal in agriculture is sugar. Big traders were short at the 85.5th percentile, an extreme bearish bet, but velocity has turned sharply positive at plus 34,599 contracts, signaling massive short covering. When a crowded short starts unwinding that fast, it creates upward price pressure independent of any fundamental change in supply. If Brazilian supply disappoints, that covering accelerates. On the flip side, cocoa longs sit at the 0.8th percentile, effectively washed out. Any supply shock from West Africa would hit a market with virtually no speculative cushion to absorb it. Now let's see how the dollar is holding up against the world's major currencies. Currencies. The dollar story this year has been modest firmness giving way to sudden weakness. The dollar index is up just 1.31% year to date, barely changed. But over the past 30 days, it has slipped against every major currency. That reversal accelerated dramatically after Friday's payrolls shock, as traders slashed bets on a hawkish Federal Reserve. The euro has strengthened 1.2% in the last month alone, and Commerzbank noted that Fed repricing is supporting moderate euro gains. Buyers are now testing the 100-day moving average. The Japanese yen is the more dramatic story, strengthened nearly 3% over 30 days, reflecting both dollar-bearish payrolls data and lingering effects of coordinated Tokyo-Washington intervention. The Australian dollar stands out as the clear year-to-date winner among majors, up 5.6% since January, powered by commodity export strength. When a commodity currency leads, it confirms the same story the metals market is telling. Real assets are in demand. In emerging markets, the Turkish lira continues its chronic decline, down nearly 11% against the dollar year-to-date, persistent inflation deterioration with no end in sight. The more interesting story is the Brazilian real, up 7.2% year-to-date, and the Korean won, up 6.3% in just the last 30 days. Both reflect commodity and export-driven gains that accompany a softer dollar. When currencies strengthen alongside commodities simultaneously, it's a signal that global growth expectations, not just dollar weakness, are driving the move. Our internal positioning data reveals just how extreme the currency repricing has been. Hedge funds were short the euro at the 97.9th percentile, essentially the most bearish euro bet in 6 years, built on the thesis of American economic exceptionalism. But that trade is unwinding fast, with weekly covering of nearly 20,000 contracts. The yen shows an even more dramatic shift, with covering velocity of nearly 61,000 contracts in a single week, the largest position adjustment in our entire dataset. When the biggest trade in the market reverses that violently, a consensus is breaking. If the next inflation print runs hot and revives rate hike talk, those covering shorts get trapped and the reversal turns violent. What does this mean for you? The dollar's modest year-to-date strength means it still buys roughly what it did in January for trips to Europe, Japan, or Canada. But the recent month-long slide has eroded that advantage. And if the weakening continues, travel abroad gets pricier while U.S. exporters and international stock holdings benefit. The bottom line, the dollar's 2026 strength is under siege, and whether it holds depends entirely on what inflation data tells us next. Now let's turn to Treasury yields and what the bond market is signaling. Treasury and rates. The yield curve is telling a story of cautious normalization. The 10-year Treasury sits at 4.63%, the 2-year at 4.18%, and the spread between them is a positive 45 basis points. The curve is no longer inverted, and the 10-year to 3-month spread at 74 basis points confirms the same message. The bond market is pricing a gentle growth slowdown, not a recession. For retirees and savers, this remains the best income environment in over a decade. A 4.18% yield on the 2-year means CDs and money market funds finally generate real returns on the safe portion of a nest egg. But for anyone considering a mortgage, the 10-year at 4.63% means borrowing costs remain demanding. Weekly changes were minimal, mostly down 3 to 4 basis points across the curve, which tells you the bond market absorbed the payrolls shock with surprising calm. When bonds barely flinch at a major labor surprise, traders had already priced in the weakness. Treasury trading volume remains substantial at about $1.1 trillion, with the 48% dealer customer share indicating active participation from pension funds and insurance companies. Real money is repositioning, not just banks trading among themselves. But the broader credit picture warrants caution. Corporate bond breadth collapsed on August 6, with declines outpacing advances by a ratio of more than 3 to 1, and new 52-week lows exceeding highs for the first time in this cycle. Agency bonds held steady, isolating the stress to corporate credit specifically. Combined with margin debt near $1.5 trillion, up 49% year over year, that is a textbook late-cycle signal, the kind of crack that appears near the top, not the bottom. Beneath the calm yield surface, the futures market is wrestling with a massive divergence. The 2-year Treasury shows hedge funds covering shorts at extraordinary speed, weekly velocity of plus 223,941 contracts, the most aggressive covering in our entire dataset by a factor of 3. That is the market pricing out rate hikes in real time at the short end. Yet the 10-year and 5-year tell a different story. Big traders are still adding shorts there, with the 10-year at the 87.4th percentile short and velocity still negative. The 5-year is even more extreme, with dealer hedge shorts at the 95.7th percentile. That gap is the bond market's split personality. The short end says the Fed is done. The long end says inflation isn't beaten yet. That gap will close. Either the short end covering proves prescient and the long end follows, or inflation data reverses and the short end gets caught. In equity futures, hedge funds are net short the S&P 500 at minus 316,802 contracts. Both longs and shorts are elevated, suggesting active positioning rather than a clean directional bet. But the VIX reading is the standout. Professional money is long volatility at the 99.5th percentile, literally the highest reading in 6 years. The market is simultaneously chasing stocks and buying insurance against a sell-off. That paired positioning is fragile, it works until it doesn't, and the unwind is violent when it comes. Bitcoin remains our only high-risk contract, with 56.6% of open interest on the short side. Any positive regulatory headline could force a violent squeeze in a trade that crowded. Connecting the dots across everything we've covered, gold at the 95th percentile long, the VIX at the 99.5th, and the S&P 500 net short together represent a massive defensive consensus, hedged against geopolitical risk and political interference with the Fed. Energy producers refusing to hedge, Treasury shorts at extreme levels, and crowded currency bets all point the same direction. The market is front-running a dovish pivot while ensuring against the possibility that it's wrong. Our stock Beaver positioning analysis as of August 4 shows danger concentrated in three areas. Bitcoin, at 56.6% short, carries our highest risk rating. The trade is extremely crowded to the downside and vulnerable to any positive headline. The 10-year and 5-year Treasury shorts at the 87th and 95th percentiles are sitting ducks if disinflation confirms. But if inflation surprises hot, those positions flip profitable fast. And gold at the 95th percentile long means anyone holding the metal through this rally should consider whether locking in some gains makes sense. The big money is positioned for a softer Fed and a weaker economy, but when that many trades lean the same direction, the real risk isn't being wrong. It's what happens when everyone tries to exit at the same time. Now let's pull back and look at the bigger economic picture, what the Fed is facing, how the labor market shifted this week, and where the economy goes from here. Economy and the Fed. The recession clock reads expansion, with an imminent score of just 27.2 out of 100. That low number tells you our basket of leading indicators is still firmly in growth territory. And here is the distinction that matters most this week. The July payrolls shock, the economy losing 23,000 jobs, that is a lagging indicator. GDP and payrolls confirm where we have been. They do not forecast where we are going. The SOM rule, our earliest jobs trigger, sits at 0.10 percentage points. It needs to reach 0.50 to signal recession, so we are a fifth of the way there. The yield curve has steepened back to normal at plus 0.79 points on the 10-year minus 3-month spread, which historically marks the back end of a cycle but not its end. Building permits are the one amber light, down 1.8% year over year, and because housing leads the economy, that is the metric to watch. But a single soft component does not flip the clock. This week's three biggest movers tell competing stories, and the tension between them is the whole narrative. Consumer spending, tracked in real time through card transactions, rose to $517.3 billion. That matters because it is a high-frequency pulse, weeks ahead of the official census report. The high-yield credit spread fell to 2.71%, its tightest in weeks. Lenders are pricing almost no default risk, which is either reassuring or a sign of complacency. And the VIX dropped another 11% to 15.15. Stock market insurance is dirt cheap. Put those three together, and the market is confidently pricing a soft landing. The real question is whether the consumer and the credit market are ahead of the leading indicators, or behind them. That consumer spending red deserves a pause. The CARTS nowcast came in at $517.3 billion through July 28, up 0.7% in a single week. Consumer spending drives roughly 70% of GDP, so this number is doing real work for the soft landing thesis. But context matters. June personal spending already slowed to 0.3% monthly from 0.9% in May. If shoppers keep opening their wallets even as hiring stalls, the expansion holds. If this is just a summer surge, front-loading vacation and back-to-school spending, the slowdown arrives in the fall data instead. The credit market is telling a remarkably calm story, perhaps too calm. The overall high-yield spread sits at 2.71%, investment grade at 0.78%, both essentially flat for a month. Think of these spreads as the price of fear. When they are this tight, lenders are pricing almost no default risk in corporate America. But here is the canary: CCC-rated distressed debt still carries a 10.17% spread, and it ticked up 11 basis points this week, even as everything else tightened. When the riskiest bonds diverge from the rest of the market, that is historically where stress begins. And when you cross-reference this with the rates decomposition, we will see shortly, tight credit plus a rising real yield. That is a classic late-cycle setup. The complacent spread is usually the thing that breaks first. The VIX at 15.15 means stock market insurance is cheap, but the divergence beneath the surface is the real story. The NASDAQ 100 volatility index sits at 23.95, nearly 9 points above the S&P, so tech stocks are noticeably more nervous than the broad market. And emerging market volatility stands at 32.11, firmly in fear territory. Calm at home, jittery abroad, that pattern is consistent with an economy that feels stable until something external disrupts it. And there is no shortage of external risks right now. When cheap domestic insurance coexists with elevated global fear, it usually means investors are pricing domestic calm against a backdrop of risk that has not yet arrived on these shores. The trade deficit widened to $73.3 billion in June, up 5.6% in a single month, and the trailing 12-month deficit is up nearly 25% year over year. That widening is no accident. A strong dollar makes imports cheaper and exports more expensive, and the dollar's strength is feeding directly into this gap. For the broader economy, a wider trade deficit is a direct subtraction from GDP, which already disappointed at 1.5% in the second quarter. The deficit hit its peak during the tariff front-running spike and has since compressed somewhat, but the 12-month moving average is still grinding wider, telling you this is a structural regime, not a one-month blip. Here is what the headline yield number will not tell you. The 5-year Treasury yield is really two things stacked together: the inflation investors expect over the next 5 years, the break-even line, plus the real, above inflation return they demand, the real yield line. Add them together and you get the nominal yield. Right now the break-even sits at 2.23%, barely budging, but the real yield component has been grinding higher to 2.17%. What that means is rates are rising because investors want a higher real return, not because they fear more inflation. For gold, that is a specific headwind. A rising real yield increases the opportunity cost of holding an asset that pays no interest, so gold's inflection comes when the real rate peaks and rolls over, not while it grinds up. And the Fed logic is critical here. When the real yield rises on its own while inflation expectations stay anchored, the market is doing the Fed's tightening work for free. That argues for hold, not cut. Cutting into oil-driven headline inflation with expectations still anchored would risk unanchoring them. The Fed's balance sheet ticked up to $6.75 trillion as of August 5, essentially flat for the week and the month. Quantitative tightening has effectively paused. The story is in the plumbing. The reverse repo facility, which has been the drainage point for excess liquidity, is down to just $1.45 billion, nearly depleted. When that facility reaches zero, the Fed has historically slowed or stopped balance sheet runoff, because pushing further risks funding stress in the financial system's plumbing. Reserve balances held at $2.99 trillion, still ample, but the trajectory matters more than the level. The Fed is approaching the line where continued QT becomes risky rather than routine. The employment cost index for the second quarter came in at 0.9% quarterly versus 0.8% expected, and wages specifically ran at 0.9% versus 0.7% expected, a 28.6% beat. That is not a rounding error. It is a signal. For workers still earning paychecks, wage growth above inflation means real income gains. But for the Fed, this is the central complication. If hiring is softening on the job side while wages are still accelerating, the Fed cannot declare victory on inflation. The last CPI reading is from June, already 67 days old, so policymakers are navigating without a fresh inflation gauge. A hot wage print with stale price data is exactly the fog that makes the next CPI release market moving. Cyclical payrolls, the factory and construction jobs that turn first when the economy weakens, held steady at 20.95 million in July. Construction added workers, manufacturing was flat. These are the positions economists watch for early recession signals, because companies stop filling these roles before they cut services hiring. That cyclical employment is still growing, even fractionally, is exactly what underpins the recession clock's expansion verdict. The leading indicators have not rolled over, and until they do, the lagging payrolls number is a warning shot, not a forecast. The freshest labor data is initial claims at 199,000 for the week ending August 1, essentially unchanged, a healthy level. But the duration breakdown tells the real story. People unemployed less than 5 weeks dropped sharply, down 22%. Fewer workers are being newly laid off. But those jobless for 5 to 14 weeks surged nearly 37%. The people who lost jobs earlier are taking longer to find new ones. The spark line on the 15-plus week category is the one to watch. When long-term unemployment grinds higher, it means hiring has slowed even as firing has stabilized. That is a hiring slowdown, not a firing wave. And historically, it is the transition phase that either resolves into reacceleration or tips into something worse. A flag worth keeping in view. FINRA margin debt reached $1.5 trillion in June, up 49% year over year and 6.1% in a single month. That year-over-year rate matters. Margin growth above 30% has historically preceded major market tops, and we are well past that threshold. The net credit balance sits at negative $1.6 trillion, meaning investors have collectively borrowed well past their cash buffers. Pair that with the tight credit spreads we saw earlier, the market is priced for calm on both the corporate side and the leverage side. When complacency in credit meets record leverage in equities, any surprise gets amplified on the way down, because forced selling from margin calls is what turns a pullback into something worse. One last read on the transmission channel. With break-even inflation expectations essentially flat, oil's price influence is landing in the real yield channel, not as an inflation scare. That is a critical distinction. Rising energy costs are tightening financial conditions as a growth and demand pressure, not because the market expects persistently higher inflation. The Fed can look through that kind of supply-driven cost shock when expectations stay anchored, and right now they are. So the appropriate policy response is hold, not hike and not cut, which is exactly where the market has the Fed positioned heading into the next inflation print. The bottom line, this week's data reinforces the recession clock's expansion call. Leading indicators have not rolled over, consumer spending is resilient, credit is calm, and cyclical jobs are still growing. The payrolls contraction is a warning shot, but it is lagging confirmation, not a forecast. The real test comes with the next inflation reading, because that will determine whether wages and prices are cooling fast enough to justify the soft landing rally. Now let us see what corporate America is actually delivering on the earnings front, because this season has produced some major beats. Earnings pulse. 3 sectors made the cut this week, and the tone across all of them is notably bullish. Technology leads as the top weekly mover with a 7.3% gain. 3 of 6 companies beat on earnings, 3 raised guidance, and the dominant tone is bullish. Healthcare carries the heaviest reporting slate, a remarkable 6 of 6 beat on EPS, 4 raised guidance, also bullish. And energy, this week's biggest decliner at minus 3.3%, still posted 5 of 6 EPS beats with a uniformly bullish tone despite the commodity headwinds. Let's break them down. The sector verdict here is unambiguous. Pricing power belongs to the indispensable companies whose products cannot be substituted, whose platforms cannot be abandoned. The starkest contrast comes from Akamai, ticker AKAM, and Fiserv, ticker FISV. Akamai beat on both lines and raised guidance, and management's pricing language was remarkably blunt. As they put it, we just mark that price right up. All GPU capacity is sold out. The company carries over $2.8 billion in multi-year cloud infrastructure commitments. Contracts include built-in inflation escalators, and Akamai still undercuts hyperscaler prices by 20% to 30%. That is a seller's market. Fiserv tells the opposite story. New CEO Takis Georgakopoulos, just 5 weeks into the role, missed on both revenue and earnings, cut full-year guidance, and launched a comprehensive portfolio review. What he called a dispassionate assessment of every product, with no preconceived size limits on potential divestitures. When a company embedded in roughly a third of U.S. merchant volume starts questioning its own product lineup, that signals pricing pressure building in commoditized financial infrastructure. Take-Two Interactive, ticker TTWO, was the sector's best reaction, up 6% since the call. CEO Strauss Zelnick called GTA VI pre-orders unprecedented and astonishing for the entire industry, and defended the $80 standard edition price by arguing games are cheaper in real terms than 20 years ago. AppLovin, ticker App, was the laggard at minus 17% despite a bullish tone and maintained guidance. Revenue came in below the midpoint, but management attributed the miss entirely to R&D timing, not demand, saying advertisers are nowhere near their spend ceilings. And CDW, ticker CDW, beat on both lines and raised its outlook, with management noting customers willingly accepted price increases on mission-critical technology. The message across the sector is clear. If your product is essential, you pass through inflation. If it is interchangeable, you are on the defensive. Pricing power in healthcare is not fragmenting. It is concentrating. Companies with clinical irreplaceability or ecosystem lock-in are pulling away from those dependent on commoditized products, and these calls made that fault line vivid. Becton Dickinson, ticker BDX, beat on both lines and raised guidance. Growth platforms biologic drug delivery, patient monitoring, and PureWick all grew double digits. Management confirmed pricing actions are already underway to offset tariff and input inflation, with CEO Poland framing it proactively. Better to assume higher costs and let improvements become a positive. Zoetis, ticker ZTS, sits on the other side of that fault line. The veterinary medicine leader beat on EPS but missed revenue and cut full-year guidance. Price realization deteriorated to flat and could reach minus 2% for the year. CEO Kristen Peck acknowledged that competitors are using aggressive discounting, rebates, and cross-portfolio bundling to win share. Dermatology revenue fell 16%. When a category pioneer starts layering on promotions to defend volume, that is structural pricing erosion, not a temporary dip. Cencora, ticker Core, was a quiet standout, up 4.6% since the call. The drug distributor beat and raised, calling its second-half ramp mechanical, not aspirational. Its pricing power sits in the Part B buy-and-bill model, where wraparound services create a moat that manufacturer price cuts cannot touch. Charles River Laboratories, ticker CRL, delivered the sector's strongest reaction at plus 14% as bookings hit their highest level in nearly 4 years. But management was candid. Pricing itself has not improved yet. The gains are structural optionality building for 2027 as capacity tightens. And Viatris, ticker VTRS, also raised guidance across all key metrics, powered by its complex generics and transdermal franchise where demand outruns supply. Energy's pricing power verdict is one of consolidation along strategic axes that cut across traditional subsector lines. The unifying theme this week was striking. These companies are not exercising pricing power through commodity price setting. They are doing it through structural cost leadership that makes them resilient regardless of where oil trades. APA, ticker APA, the sector's best reaction at plus 8.6% raised guidance despite missing on both lines. The story is operational efficiency. APA now sustains 123,000 barrels per day of Permian oil with just 4 rigs, down from an original plan of 8. Run rate cost savings reached $500 million, and management framed the efficiency program as a $600 million free cash flow uplift versus doing nothing. Occidental, ticker Oxy, beat and raised, delivering perhaps the line of the week for this group. 85% of its targeted $4 billion cash flow improvement by 2030 is achievable even at much lower oil prices. ConocoPhillips, ticker COP, beat and maintained, with Permian production up 10% year-over-year, the fastest growth among major peers, and free cash flow breakeven compressing from the mid-$40 to the low $30s per barrel by 2029. The midstream and royalty names showed where volume, not price, drives results. Targa Resources, ticker TRGP, guided to the top of its $5.7 to $5.9 billion EBITDA range on record Permian gas throughput of 7.2 billion cubic feet per day, up 14% year-over-year. Texas Pacific Land, ticker TPL, fell 10.8% despite record quarterly revenue of about $246 million. The market apparently wanted more tangible progress on data center land negotiations. And Devon Energy, ticker DVN, beat and maintained, with management confident that post-merger clarity will bring investors off the sidelines. The through-line across all three sectors is clear. Pricing power is concentrating, not broadening, toward AI-critical infrastructure in technology, clinically irreplaceable products in healthcare, and low-cost operators in energy. The winners are not just raising prices. They are lowering their cost to produce and letting volume do the work. Now let's see how this lands on our top stock and ETF picks. Market technicals. On the year-to-date scoreboard, technology stocks have led the market, up just over 30% since January. Your tech funds are carrying the portfolio this year. But here is the surprise. Tech is not the most stretched part of the market. Its RSI, a short-term momentum gauge that runs from 0 to 100, has cooled to 42, below the midpoint. So the leader has taken a breather even while holding big gains. Breadth underneath is solid. About 85% of the names we track sit above their 50-day trend line, meaning most stocks are participating in the rally, not just a handful of giants. On the risk board, the market is comfortably rewarding risk right now. Healthcare, financials, and tech are the leaders over the past 3 months, while long treasuries, utilities, and communications sit at the bottom. That is nervous money leaving the safest corners and rotating into growth-oriented sectors. If there is one spot running too hot, it is the financials. Your bank and insurance stocks are trading more than 8% above their own trend line. That is the kind of stretch that usually pauses for a breath before going higher, so it is the one to watch, not panic about. On sector momentum, financials sit at the top with the highest reading, and their RSI is above 65, overcooked territory. Yet financials are only up about 5% for the year. When a sector is the hottest in the room but has barely moved year to date, that is late money chasing, and it is the most vulnerable to a pullback. On the other end, utilities and communications are the most beaten-down sectors, negative on both price action and performance relative to the broader market. Washed-out names like these are often where patient investors look for value, but only when they start to stabilize. On investing styles, the clear favorite is deep value, bargain price stocks. Deep value has both strong momentum and is beating the broad market, a pattern holding for 5 straight weeks. On the opposite side, long bonds and emerging markets are deeply out of favor with negative readings across the board. One rotation signal worth noting. Momentum investing is drifting through the middle of the board, barely positive on price. When a dead money style starts to cross back toward positive territory, it can mark the beginning of a shift underneath the surface. On the overall technical picture, the health score reads 78.9 out of 100, and our system labels that as extended. Think of it like an engine running in the upper range, not redlining, but not idling either. That reading confirms the price line. The market has rallied hard, and the technicals back that strength. It simply means the easy gains have likely been made, and forward returns may come with more chop along the way. On money flow, our internal volume-based reading sits at 73 out of 100, squarely in accumulation territory. That means institutional-sized money is still flowing into equities rather than heading for the exits. It agrees with price, which is exactly what you want to see. The day those two diverge at price climbing while money quietly leaves is the day to pay closer attention. On the stock Beaver sentiment composite, the crowd sits at 68.6, which reads as greed. The single biggest driver is the calm and options markets. The VIX fear index is very low at 15.15, scoring above 90 on our scale, and that low fear is doing most of the heavy lifting on the greed reading. Momentum is also strong at 85, but the longer-term trend has actually been cooling compared to a year ago, when confidence ran notably hotter. The crowd is greedy, but less so than 12 months back, a healthier setup than peak euphoria. The one thing a non-trader should watch this week: if financials keep climbing while their momentum gauge stays above 65, that is the most stretched corner of the market, and the likeliest place a pullback would begin. Top stock picks. The buy signal radar is lit up this afternoon. Roughly 130 stocks are currently flashing mechanical buy signals, a remarkably broad showing that matches the bullish tone of today's session, with the S&P 500 up 0.6% and the NASDAQ climbing 1.3%. Let me walk through the names with the longest consecutive buy streaks, because persistence tells you the trend has real staying power. Zebra Technologies, ticker ZBRA, leads with 4 consecutive buy days, and it is what we call a high confluence name. It appears on the buy signal radar and also ranks among our top momentum stocks. Dell Technologies, ticker Dell, carries 3 consecutive buy days with the same dual ranking across our momentum and top picks lists. Hewlett-Packard Enterprise, ticker HPE, also at 3 buy days, same setup. And Shopify, ticker Shop, on a 2-day buy streak, pulling double duty as well. When a mechanical buy signal aligns with strong performance rankings, that convergence is the most compelling pattern we track. Starting with what is hot this week, Shopify is up 29.4% over the past 7 days, the biggest weekly mover on our entire radar. The catalyst is clear. The company delivered what multiple outlets call its strongest earnings reaction in recent history, beating second quarter estimates as gross merchandise volume surged and AI-driven commerce gained traction across channels. The stock sits at $151.57, up 27.1% over the past month, though it remains down 3.6% year-to-date. So this week represents a powerful reversal of a disappointing first half. Right behind it is Zebra Technologies, up 28.1% this week and 44.8% over 2 weeks, now trading at $376.49. According to news reports, Zebra posted record second quarter sales with organic sales growing over 9%, and management raised full-year guidance across the board. The company makes enterprise computing and tracking devices for warehouses and supply chains, and reports indicate demand is running ahead of available supply, particularly in AI-enabled devices and machine vision systems. That pricing power narrative fuels a 42.4% gain over the past month. Airbnb, ticker Airbnb, surged 17.5% this week to $178.7 after notching one of its strongest growth quarters in years. CEO Brian Chesky credited AI for accelerating the business, with second quarter earnings and revenues both beating estimates and booking demand accelerating. Airbnb is up 24.6% over the past month and nearly 47% over 6 months, and at 33.9% year-to-date. It is one of those rare names that is hot this week and a leader all year. Charles River Laboratories, ticker CRL, gained 15% this week to $267.49 after beating second quarter estimates and raising full-year guidance for revenue, earnings, and free cash flow. The contract research organization serves drug companies with discovery and safety testing, and cited improved demand in that business. The stock is up 44% over 6 months and nearly 79% over the past year. And this aligns with what we saw on the earnings pulse earlier, where healthcare names delivered broad beats this season. Now to the swing and recovery names, stocks working back from deeper slumps. Skyworks Solutions, ticker SWKS, up 13.4% this week to $70.62, fits this profile. The semiconductor company is showing clean trend improvement after a difficult stretch, with consistent momentum building. Broadcom, ticker AVGO, on a 3-day buy signal, is up 9.9% this week to $427.76, with choppy but accelerating action. Broadcom remains one of the premier semiconductor franchises powering AI infrastructure, up 24.4% over 6 months despite near-term noise. Charter Communications, ticker CHTR, also on a 3-day buy signal, priced $4.75 billion in senior secured notes this week as part of a debt refinancing, actively managing its balance sheet while the stock recovers from a steep multi-year decline. Salesforce, ticker CRM, carries a buy signal with steady momentum. CEO Mark Benioff argues that AI agents will make Salesforce more essential, not less, and the stock is up 8.6% over the past month. Accenture, ticker ACN, shows a strong steady trend, up 5.9% this week and 28.1% over the past month. The consulting giant has faced softer bookings and cautious enterprise spending, but recent price action suggests investors are looking past near-term headwinds. Now for the big picture, the strongest performers over 6 months, where the durable trends live. Dell Technologies leads this entire list with a 275.3% gain over 180 days and 255.1% year-to-date. Dell is the quintessential AI infrastructure play, building the servers and data center systems that power the AI boom alongside a deepening partnership with NVIDIA. Stock pulled back over 5% in one recent session, but the multi-month trajectory is extraordinary, and it remains on a buy signal. Hewlett-Packard Enterprise is close behind at 122.6% over 6 months and 120.2% year-to-date, now trading at $53.22. HPE competes directly with Dell and Supermicro in the AI server market, and its own NVIDIA alliance continues to deepen. The stock is up 11.2% this week alone. Steel Dynamics, ticker STLD, deserves attention, up 49.1% year-to-date and 115% over the past year with a consistent, steady trend. The steelmaker represents the industrial leg of this market rally, and its reliability stands out among more volatile tech names. Booking Holdings, ticker BKNG, rounds out the long-term leaders at 26.5% over 6 months, now at $214.42. The travel platform posted better than expected second quarter results with resilient global travel demand, even as management acknowledged near-term volatility from Middle East conflict. The stock is on a buy signal and up 23% over the past month. What ties these names together is fundamental confirmation. Zebra, Shopify, Airbnb, and Charles River all delivered quarterly beats that validated their upward trends. Dell and HPE are riding genuine AI infrastructure spending. When earnings catalysts line up with technical momentum, that is where the highest quality setups form. A quick smart money side note. Across our picks this week, shorts are mostly behaving, no extreme builds or covers stand out among our key names, meaning the bullish moves are not being aggressively faded. When short sellers are not piling into names like Dell and Zebra even after their enormous runs, that is a quiet vote of confidence. For investors thinking about risk, a stock without heavy short interest is less vulnerable to cascading selling after a disappointing headline. This is education, not advice, but understanding where the bears stand adds one more layer to how we read momentum. Top ETF Picks. The buy signal radar is lighting up across the leveraged ETF universe. Over 170 leveraged ETFs are flashing active buy signals right now. That is a broad risk-on backdrop. The longest streaks belong to a cluster of funds on buy for 4 straight sessions. JNUG, the Dirksen Junior Gold Miners 2X PALU, the Palo Alto Networks 2X CSCL, the Cisco 2X, and USD, the ProShares Ultra Semiconductors Fund. What gives these high conviction is confluence. Several appear on both the buy signal list and our momentum or swing rankings, confirming the trend from multiple angles. A critical reminder, leveraged ETFs use derivatives to amplify returns and losses. They are for short-term trading only and decay if held long-term. Keep positions small and have an exit plan. These are short-term trading vehicles, not something to buy and hold in a retirement account or with money you are counting on. The hottest performers this week are dominated by 2 themes: artificial intelligence and precious metals. PTIR, the GraniteShares 2X Long Palantir Fund, leads the entire leveraged space with an 82.9% gain over 7 days, trading at $18.49. Reports cite a weak jobs print that reduced the odds of a near-term Federal Reserve rate hike, sparking a rally in growth and technology names. GDXU, the Gold Miners 3X Fund, surged 73.9% this week as gold and silver spot prices each climbed 4 to 5%. AVXX, the 2X Long AeroVironment Fund, gained 53.1%, though investors should note that Defiance announced reverse stock splits across several leveraged ETFs this week, a structural adjustment rather than a performance signal. The year-to-date leaders reinforce the technology theme. DLLL, the 2X Long Dell Fund, leads with a 763.9% year-to-date return. Dell has quietly become an AI infrastructure play, and that thesis has been extraordinary in leveraged form. PALU, the Palo Alto Network's 2X at $56.84, is up 234.5% year-to-date and appears on both the weekly and YTD lists, which is the kind of confluence that catches our attention. ZETX, the Zeta 2X fund, also straddles both lists, up 48% this week and 93.1% year-to-date. CSCL, the Cisco 2X, has gained 121.7% year-to-date, and CRWL, the CrowdStrike 2X, sits at 165.5%. These are sustained momentum stories, not one-week pops. The swing and recovery category is where the precious metals theme deepens. NUGT, the Gold Miners Index 2X, is up 45.1% over 7 days and 77.4% year-to-date, the same safe haven bid lifting the miners that we have seen in the commodity space all summer. AGQ, the ProShares Ultra Silver, gained 20.2% this week. But here is the caution worth hearing. Analysis published this week showed that AGQ has historically underperformed unleveraged silver ETFs because of structural decay from its daily reset. Over nearly 17 years, it compounded at roughly 2% annually versus 8.4% for a physical silver fund. That is precisely why discipline matters with these products. COPZ, the 2X long copper miners fund at $17.41, is also recovering, benefiting from the same commodity tailwind now extending into industrial metals. On the leveraged technical side, several funds show clean setups. USD, the ProShares Ultra Semiconductors at $93.67, displays a golden cross with MACD momentum building. TSMX, the TSM2X, and ASMG, the ASML2X, show the same pattern, both riding the semiconductor cycle that this week's technology earnings pulse confirmed, with multiple companies raising guidance. For broad market exposure, UMDD, MIDU, and UDOW, the mid-cap and Dow 30 leveraged funds are all accelerating, suggesting the rally is broadening beyond megacap tech. MSFU, the Microsoft 2X, is also notable, up 15.1% this week as Microsoft's AI and cloud strength continue to attract buyers despite a recent correction in the underlying stock. Now let us check what the smart money is doing. Thursday's FINRA data shows QB, UJB, and GCSH topping the highest short percentage panel, each near 100% of daily volume. On the raw volume side, the largest short positions concentrate in a different set of names. Remember, most short volume is intraday market maker plumbing. The real signal lives in the extremes and in any overlap with our picks. None of today's highlighted funds appear at the very top of either panel, which means hedger positioning is not contradicting the bullish trends we just walked through. Looking specifically at the ETFs on our list, hedger activity is broadly normal this week. No major shorting surge or short covering signal stands out among our picks. That is a quiet vote of confidence. When the technicals look bullish and the smart money is not leaning hard against you, the trend has room to breathe. But in the leveraged ETF world, room to breathe also means room to reverse, which brings us back to the same discipline. Size your positions, know your exit, and remember that the same leverage amplifying this week's gains will amplify next week's losses if the tape turns. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. We start with the put-call ratio, or PCR. Think of it as a sentiment thermometer. Calls are bets a stock goes up. Puts are bets it goes down, or insurance against a drop. When the PCR rises above 1, traders are buying more puts than calls, they're nervous. Under 0.5 means extreme bullishness, which can actually be a contrarian warning. Today's aggregate PCR across the 3 major index ETFs sits at 0.945, just under 1. That's neutral territory. SPY is at 0.946, QQQ at 0.936, and small caps in IWM right at the line at 0.993. All 3 land in the same zip code, no major disagreement between large caps, tech, and small caps. Traders aren't panicking, but they aren't throwing confetti either. Now the SPY 25 Delta skew, which measures the cost of out-of-the-money put insurance versus out-of-the-money call lottery tickets. A high skew means crash insurance is expensive. Fear is showing up in pricing even if the index hasn't broken. Today the skew reads just 2.5 points. That's low. Crash insurance is cheap right now, nearly the same cost as upside calls. That's complacency, not fear. So the PCR says cautious, but skew says calm, slightly mixed signals, leaning toward a market that feels comfortable with where it stands. Next, dealer positioning, and this is the hardest concept on the board, so bear with me. Market makers, or dealers, are the middlemen who sell most option bets to you and me. They hedge those bets with the underlying stock, and how they hedge is what creates the pinning and squeeze dynamics we track. Their behavior is captured in something called gamma exposure, or GEX. Positive GEX means dealers act like a shock absorber. They buy dips and sell rallies, which dampens volatility and tends to pin the index near a center price. Negative GEX means the opposite. They sell into weakness and buy into strength, amplifying every move. Today, all three major indices are in positive gamma shock absorber mode. SPY carries net gamma of roughly 39,000 with a gamma flip at 738. SPY closed at 773, comfortably above that flip. As long as it holds above 738, the calming dynamic stays intact. Drop below it, and the shock absorber breaks, moves get bigger fast. Max pain for SPY sits at 756, about 2% below current levels. Max pain is the strike where the most option contracts expire worthless, and it can act like a gentle magnet pulling price toward it into expiration. QQQ tells a similar story, positive gamma of roughly 38,000, flip all the way down at 661, and the index trading at 723. Max pain at 698. Small caps in IWM are also positive gamma at about 28,000, with a flip at 296, but IWM sits at 301, only about 1.8% above that flip. That's the one to watch if risk-off sentiment hits, because small caps are closest to the threshold where the regime switches. The big picture: across large caps, tech, and small caps, dealers are in dampener mode. Expect choppy, range-bound action rather than sharp trend days, unless something breaks us below those flip levels. Now to sector volatility. Implied volatility is what the options market forecasts for future swings. Realized volatility, or historical vol, is how wild the sector has actually been. When implied runs above realized, options are bracing for something. Energy stands out as the richest. XLE options are priced at 1.22 times what the sector has actually delivered. That premium usually shows up before an oil catalyst or geopolitical risk. Silver, through SLV, is close behind at 1.17, not surprising given the precious metals rally this week. On the cheap end, semiconductors are the real standout. SOXX shows implied volatility at just 0.70 times realized. Options are pricing in far less drama than the chip sector has actually experienced. After a week where AMD, Intel, and Nvidia all made major moves, option premiums simply haven't caught up. That can signal complacency or a bet that the fireworks are over. Communications via XLC is also cheap at 0.80 times realized. For option sellers in these sectors, premiums are thin, buyers aren't paying up. Let's look at where big options flow landed today, focusing on names with confluence, tickers that show up in multiple parts of our framework. Oracle, ticker ORCL, leads the board with about 85,000 contracts traded and a put-call ratio of just 0.9. That is overwhelmingly bullish. For every put, roughly 11 calls changed hands. Oracle also appears in today's Senate trading segment, and the high volume-to-open interest ratio signals fresh positioning, not routine roll activity. That's the kind of cross-confirmation we look for. Nvidia, ticker NVDA, saw about 58,000 contracts with a PCR of 0.34, solidly bullish, and it overlaps with house trading activity. Amphenol, ticker APH, shows up with a PCR of 0.11 on the unusual flow scanner and also appears in our insider activity segment. Insiders and options traders leaning the same direction, that adds conviction. On the bearish side, IWM saw heavy put buying with a PCR above 8, defensive hedging or outright short positioning in small caps, consistent with that closer gamma flip we just discussed. For anyone running a covered call strategy, selling call options against shares you already own to generate income, a few names stand out where implied volatility is rich. Marvell Technology, ticker MRVL, leads the board at 95% implied vol with an IV rank of 58, meaning volatility is in the upper portion of its own recent range. A call about 15% out of the money is pricing roughly 68% annualized. Dell and ARM sit in a similar zone, rich premiums, but these are high beta names that genuinely move that much. Oracle also appears at 75% implied vol with an IV rank of 51, consistent with the heavy call activity we just flagged. Important caveat: the premium is rich precisely because the stock can swing hard. A covered call caps your upside on exactly the rallies that would have rescued a drawdown, so size accordingly. Now let's bring that backdrop down to our picks, specifically, where in today's stock list does options positioning also argue for higher prices. We pre-filtered the pick list to one name. It qualified via clear bullish positioning bias rather than the strict gamma squeeze checklist. The scorecard shows only picks where options activity leans bullish, neutral and bearish names were already dropped. Each row carries a squeeze phase label. Pre-fire means a coiled spring. Mid-fire means the amplifier is on. Late means the move is mature with exhaustion risk. Long gamma means dealers are running a dampener, no squeeze setup. Today we have just one name, Hewlett-Packard Enterprise, ticker HPE, tagged long gamma. That's a suppressive regime where dealer hedging dampens moves. So this is about positioning bias, not a coiled spring setup. Let me teach the framework. A real gamma squeeze setup needs four things at once. The stock trading below its gamma flip so the amplifier is switched on, gamma exposure actually negative, a call wall 3 to 15% above for runway, and a put wall in the same zone for a floor. HPE doesn't pass that strict checklist. It's trading above its flip at 41.71, which puts dealers in dampener mode, not amplifier mode. But HPE qualified through bullish positioning bias. Its upside score of 41 dwarfs the downside score of 4. The put-call ratio on volume is just 0.198. For every put, 5 calls traded. Open interest skews the same way at a PCR of 0.48. And the 25 delta call skew reads negative 8.6%, meaning upside calls are bid relative to downside puts. That's unusual, and it signals real demand for upside exposure. Different reason than a squeeze, same direction. HPE at 53.22. Dealers are in dampener mode. The gamma flip sits at 41.71, and spot is well above it. That means dealers sell rallies and buy dips, keeping the stock range-bound rather than amplifying moves. The call wall at 55 is the level to watch, only about 3% above current price, so it's a nearby ceiling where dealer hedging would slow any rally. The put wall sits at 40, roughly 25% below. That's your structural floor where dip buyers emerge. Max pain is at 48, about 10% under spot. With earnings 26 days out on September 2nd, this positioning red matters between now and then. Earnings will reset the entire option structure. Let's go inside the numbers on HPE. And with just one candidate today, I'll use the time to teach the mechanics. First, gamma exposure. Net GEX is about $8.2 million positive. Dealers are long gamma, which means dampener mode. Think of it as a shock absorber on a car. When the stock jumps, dealers sell into it. When it drops, they buy. That keeps price oscillating in a band rather than trending sharply in either direction. Second, VANA, that's how dealer hedging shifts when implied volatility changes. Net VANA is positive at about 1.2 million. Positive dealer VANA means if volatility spikes on bad news, dealers actually sell the underlying stock, which would amplify downside. The flip side, a volatility crush after uncertainty resolves would be supportive for the shares. With earnings approaching, some of that volatility premium is already building in. Third, charm, how dealer hedging shifts as time passes toward expiration. Net charm is negative at about $2.3 million per day. Negative charm means dealers are gently selling shares each day as options decay. That's a steady structural headwind into expiration, worth knowing about even though it's a slow drag, not a shock. And fourth, the positioning tilt itself. Call open interest is about 158,000 versus put open interest of just 76,000, roughly 2 calls for every put. Combined with the negative call skew, the options market leans clearly bullish on HPE. The dealer gamma regime won't amplify the move, but the flow is pointing one direction. Remember, this whole segment is positioning context, not a trade idea. A picks list with a bullish tailwind underneath it is a higher quality setup than one without. That's the only claim. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. The biggest fresh disclosure comes from Senator Tommy Tuberville, who filed a sweeping batch of trades this week, though the transactions themselves date back months, some as far as April 2025. The pattern is clear. Tuberville sold Apple, Microsoft, Alphabet, Oracle, Qualcomm, PayPal, and PepsiCo, then redeployed into 3 defensive sector ETFs, healthcare, ticker XLV, utilities, XLU, and consumer staples, XLP. On the House side, Representative David Taylor disclosed purchases of Microsoft, Broadcom, and Kroger, while Lloyd Doggett picked up Coca-Cola. The weekly cluster data shows 2 senators, Tuberville and Shelley Moore Capito, both selling Apple, Microsoft, and Intel. 8 Apple sales across just 2 members stands out as the most concentrated selling activity of the week. In the House, Kroger drew cluster buying from 2 members, while Fifth Third Bancorp saw cluster selling. Zooming out to the last 30 days, the 2 chambers are pulling in opposite directions. The Senate has been net buying, with 107 purchases against 96 sales, and United Health drawing interest on the healthcare side. The House tilted firmly towards selling, 176 sales against 137 buys, led by unloading of Alphabet and the newly spun-off Honeywell Aerospace, which tumbled over 20% after its debut earnings report. For retirement-focused investors, Tuberville's rotation into defensive sector ETFs mirrors a broader flight to safety that this week's weak jobs report only amplified, with healthcare and utilities attracting fresh money while megacap tech gets trimmed. Insider activity. The strongest insider signal this week came from Boston Scientific, ticker BSX, where 3 executives bought a combined $9.39 million in shares. Coordinated buying like that, multiple insiders stepping in at once, is the single most bullish pattern in this dataset. Pfizer, ticker PFE, saw 2 insiders purchase $1.96 million this week, following Pfizer's confirmed second quarter earnings on August 4th. A supporting signal. One insider at Aptiv, ticker APTV, committed $5 million. The broader backdrop leans towards selling just 34 buys against 1063 sells over the past 14 days, a ratio of 0.3, but much of that reflects routine diversification, not alarm. Outside the major indices, 2 purchases dwarf everything else on the board. Angeliki Frangou poured $846.7 million into shares of ticker NMM. Albert Lord spent $115.9 million on APCX. Together, those 2 buys account for roughly $960 million in insider capital flowing into companies well off the beaten path of the major indices. When insiders deploy personal capital at that scale, it's not portfolio rebalancing, it's conviction. Insiders know their businesses better than anyone, and when one person commits hundreds of millions of dollars in a single purchase, that's about as strong a signal as the market gives. Federal budget. Through August 6th, the government collected $76.86 billion in net receipts against $95.7 billion in spending, an $18.21 billion deficit for the first week of August. That's $87.7 billion better than the same 6 days last year, but a single week of relief doesn't change the structural math. Here's what does. On the fiscal year, interest on the debt has now eclipsed the entire Defense Department, nearly $800 billion versus $679 billion. When the cost of financing yesterday's borrowing rivals what we spend defending the country tomorrow, that tells you the deficit isn't just a line item. It's competing for the same dollars. Social Security led monthly outlays at $27.48 billion, and on August 6th alone, $3.96 billion went out the door for Medicaid grants to states, mandatory spending that runs on autopilot, deficit or not. Zoom out to the full fiscal year. The government has collected $4.90 trillion and spent $6.34 trillion, a $1.44 trillion gap that we're running every single year. Look at the decade view and the pattern is clear. Spending jumped during COVID and the elevated baseline never came back down, while receipts grew but couldn't keep pace. The full-year pace points to a $1.82 trillion deficit. The story within that story is interest. It climbed from $1.15 trillion in 2024 to $1.27 trillion this year, and the trajectory suggests $1.40 trillion next. That's not spending you can cut. It's the compounding cost of decisions already made. Each year's deficit adds to the debt, and each addition locks in a higher interest bill. The loop is already visible in the numbers. The national debt stands at $39.89 trillion. That's $119,000 for every person in the country, a burden that doesn't appear on any household bill but shapes every fiscal decision Washington makes. The pace is accelerating. The most recent trillion took just 4.8 months to accumulate, and at this rate, $50 trillion arrives by June 2029. Measured against the economy, debt to GDP sits at 123%, well past the 100% threshold that economists historically flag as the zone where debt starts crowding out growth. We crossed that line during the pandemic and never came back. This isn't a spike anymore, it's the new baseline. Who holds the note? Private domestic investors own the largest share, $27.4 trillion, roughly 68%, meaning pension funds, mutual funds, and households have the biggest stake in getting paid back. Foreign investors hold $9.27 trillion, and the composition is shifting. Japan still leads at $1.14 trillion, while China has steadily trimmed its position to $659 billion, down from $731 billion a year ago. A quiet diversification away from U.S. Treasuries that, if it accelerates, means domestic buyers have to absorb more. Then there's the rate. The average interest on marketable debt has climbed from 2.96% to 3.44%, applied to $31.5 trillion in securities. That's what produces the $1.40 trillion annual interest bill we just walked through. But the real risk is the rollover. $7.64 trillion, About 24% of all marketable debt reprices within 12 months. Every 25 basis points adds $19.1 billion in annual interest. A full percentage point adds $76.4 billion straight to the deficit, which adds to the debt, which means more to roll over next year. Think of it as an adjustable rate mortgage on a national scale, manageable when rates were at zero, punishing at today's levels, and compounding with every rollover cycle. Week ahead. No magnificent 7 earnings this week, but the calendar still carries real weight, heavy on AI infrastructure names, with a critical inflation print sitting right in the middle of it all. Let's start with earnings. Monday is a quieter opener. Ferguson, ticker FERG in industrial distribution, Rocket Lab USA, ticker RKLB in small launch space, and Simon Property Group, ticker SPG, the nation's largest mall operator and a useful gauge of consumer foot traffic. Tuesday is the day to circle. Super Microcomputer, ticker SMCI, reports and investors will be watching closely after reports suggested revenue may land near the low end of guidance. CoreWeave, ticker CRWV, the AI cloud provider whose backlog has been growing roughly 50% sequentially, also reports that morning. Cardinal Health, ticker CAH, offers a healthcare distribution read, while Lumentum, ticker Light, and Biotech, ticker Tech, round out the session. Wednesday brings Cisco Systems, ticker CSCO, a bellwether for enterprise IT spending, alongside Coherent, ticker COHR, another optical name tied to data center demand. Amcor, ticker AMCR, and Nebius Group, ticker NBIS, the AI cloud platform, complete the day. Thursday closes the calendar with Applied Materials, ticker AMAT, a key lens on semiconductor capital equipment spending, and Tapestry, ticker TPR, parent of Coach, for a window into premium consumer demand. Now to the economic data, and this is where the week gets serious. Wednesday is the main event. July CPI drops at 12:30 Eastern. Headline CPI is expected to rise 0.1% month over month, rebounding from June's sharp 0.4% decline, with the year-over-year rate easing to 3.4% from 3.5%. Core CPI is projected at 0.2% monthly. Coming off a week where markets aggressively repriced Federal Reserve expectations after that surprising jobs contraction, this print will be picked apart for confirmation that inflation is moving in the right direction. Thursday brings producer prices, PPI expected at 0.1%, plus initial jobless claims near 198,000, and speeches from Fed officials Hammack and Barkin. Governor Bowman speaks Saturday afternoon. Tuesday's existing home sales, projected at an annualized 4.7 million, along with the MBA mortgage rate update Wednesday, will frame the housing picture. On the IPO front, it's quiet. ARIAD Pharmaceuticals lists on the NYSE Monday under ticker ARIA. No pricing details are available. It's a data-heavy week with inflation at the center of everything. I'll be right here breaking it down as the numbers land. That's your week ahead. As we near the end of the podcast, the key takeaways are: the weak jobs report fueled a powerful rally because traders see rate hikes ending, but with volatility positioning near record highs and gold crowded at the 95th percentile, this consensus unwinds fast if inflation surprises. The next CPI release is the single number that tests everything. Find interactive charts and screener data at stockbeaver.com. Thanks for watching. I'll see you tomorrow.